We're going to talk about how to use your registered accounts, RRSPs, to invest in other opportunities like mortgages. And I actually didn't know this until about a few months ago when we met. And why don't you tell us how that works? I know our fellow Americans have a similar strategy where they can use their IRAs or their 401ks. In Canada here, we're limited or what we can do with RRSPs, but now we can actually use RRSPs to invest in mortgages. And how long has that been around, this technique?
Oh, it's probably been at least 20 years or
more. So it's not new.
No, this is not new. It's been around for a long time. It's mainly been known in the commercial real estate world, not so much in the residential small landlord world. Many years ago, when I'd been investing for a while, and I came across this technique on how to use RRSP money, other people's RRSPs, to basically invest in my own properties. So I could borrow someone's RRSPs and secure it as a mortgage against my property. And it was great because I didn't have to go to the bank and go through all the hoops and all the paperwork you need, all the verification, all that stuff.
Yeah.
It was all out the window. I could just basically find an individual like yourself, and let's say you had 50,000 or 100,000 in your RRSPs, and it was making low or negative returns. I could show you how to get a secured return that basically was secured by real estate, versus an unsecured return when you're dealing with the stock market, mutual funds. With stock market, it can go to zero, as some people have discovered over the last few years.
Okay.
So it was quite an exciting discovery. And since then, I've been using it in my investing, and I've actually been teaching people how to do it as well.
Okay. Why haven't most people heard of this?
I have no clue. I guess mainly it's probably because government...
There's no money to be made by institutions? Or
no.
Do they make money on it?
Well,
this promoting this technique?
Well, it's not a typical investment that a financial advisor would promote because they don't get paid from it. Mortgage brokers would, and many of them do know about these types of mortgages.
Okay.
They just, I'm not sure why they don't promote them. They would get paid, but from the borrower, basically.
Okay.
They have to pay the mortgage broker fees.
Okay.
Now, I don't go through mortgage brokers to do this. I discovered how to do it on my own, so I bypass all those fees.
Okay.
So it's very low cost, and basically the person who's lending the money gets a very good return. It is secured by real estate, and it's all tax sheltered. It all stays within the tax shelter of the RRSP.
So let's dig in deeper a little bit. Obviously, the two people dealing with each other, they have to, there are rules. It could be anybody or the borrower and the lender. Are there rules for that?
Yep. CRA has very specific rules about this. And the types of mortgages that I'm talking about, the types of RRSP mortgages, are what's called arm's length mortgages.
Arm's length.
So that means you and I can't be related by blood, adoption, or marriage.
Okay, you can't
directly
do this with your brother, your mom, your dad.
Yeah, they have very specific people you can and you can't.
Okay.
So arm's length basically means anybody except those. I believe it includes aunts, uncles, some cousins as well.
Okay.
But not parents, not children, nobody you're married to, that sort of thing. There's very specific rules. Also,
that you can't do it with.
That's right.
Okay.
And as well, if you own a controlling interest in a corporation, there can be no connection there as well.
Makes sense. Okay.
So yeah.
So let's say that you happen to find that person, either a friend or a business colleague, neighbor, and what's the first step?
Basically, because you're dealing with registered funds, I can't just go and take the money out of your RRSP, for example. No. Because it's registered, it has to go through a financial institution.
Okay.
Now, don't worry, it's not like, you have to get a mortgage through a bank. It's not like that at all. There are what are called trustees, and there are financial institutions. They act as a middleman, but sitting between you and I, basically shuffling paper and money. Okay. That's all they do. And the fees are very low for this in comparison to dealing with a mortgage broker.
There's an initial cost to set this up?
It's very, very low. When you're dealing with arm's length mortgages, it's very, very low.
And how much, typically, how much does that cost, and who pays this fee?
I see. Well, the way I teach it and the way I do it is that if I'm borrowing your money and let's say I've agreed to give you an 8% return or 9% return on your money.
Guaranteed. Okay.
Yeah, and I never use the word guaranteed because I use the word secured.
Secured. Okay.
You can get in trouble with securities regulators when you use guaranteed.
Okay.
But basically, I use the word secured because the investment is secured by property. It's a mortgage. That's the nature of a mortgage, that there's underlying property that's securing that investment.
Okay.
Okay. So basically, it's a secured investment, and because like, let's say I'm going to pay you 8 or 9% return.
Okay.
On it, then basically the trustee, I have to do some paperwork basically to get things set up. And when everything is all said and done, it goes through a lawyer and everything. The money comes out of your RRSP.
Okay. It
comes to me, and in your RRSP, on your statement, your trustee statement, it will show your RRSP investment. It will show, instead of a stock or a mutual fund, it'll show
number.
A mortgage number, whatever. Who's the
property,
person, the interest rate, and so on.
That was negotiated with the
That's
board.
correct.
And are all financial institutions in Canada doing
no,
being the trustee?
No, not at all. There's only that I know of about 4, and I deal with one because they're the biggest name in Canada. It's TD Waterhouse.
TD Waterhouse. I deal with. Everybody knows TD Waterhouse. They're obviously huge and legit. So this is obviously a technique that's been around for a long time.
Yep.
Why would somebody borrow at 8%?
That's a good question. When I said 8%, what I'm talking about there is, for example, a second mortgage.
Oh, a second mortgage.
So, yeah.
Okay.
So now it's not limited to second mortgages. You can do an RSP mortgage as a first, a second, or a third.
Okay.
They won't go above thirds, and I would never go for thirds anyways. But if I was, basically offering a first mortgage to you, I would not be paying 8%. I would be paying a much lower rate.
Yes,
we're at
of
all-time
course.
interest rate lows.
Okay.
So basically, I wouldn't be going that route. But if I was going for a second, because it's in second position, it's potentially riskier than a first position mortgage, so the interest rate is higher.
Okay.
So I normally, what I've seen and what I've done, basically what I've seen with my students as well, basically they'll go in and then maybe they'll buy and they'll get a first mortgage in place. They'll put, let's say, 20% down on a property to buy it. And then maybe a little while later, they'll go and they'll take some of their down payment out by putting a second mortgage, RSP mortgage, on the property to extract some of that down payment out after the fact. And these mortgages are awesome. These arm's length ones, they're so flexible. Basically, the trustee, they have very, very few rules around it. And so, for example, let's say I was buying a property, and let's say you had 300,000 in RSPs, which is rare. Not a lot of people have that amount, but let's say you did, and you wanted a very good return. Well, let's say I'm going to pay you 6% on a first mortgage, but I know that the property I'm buying, maybe in the first couple of years, like I've got some bad tenants in there, and the rents aren't high, and there's some problems. So I need some time to get the tenants out, fix the place up, and renovate it, raise the rents, raise the revenue. Okay. We can structure something very flexible. Like I could say maybe in year 1 and year 2, I'm going to pay you 1 or 2%. Okay. But it's going to accrue at 6%.
Over time.
Over that same time period. So it's like basically I owe you 6, but I'm only going to pay you 2 out of my cash flow for that period of time. And then I'll catch up in the later years.
Meaning you'll pay more like 9 to 10% later on, and then, for the average is 6%.
That's right.
Okay.
So it's got some very, very flexible features. Now you will never see anything like that with a traditional bank or lender or anything like that. But with these types of mortgages, because I'm dealing with a private individual, we can make it whatever we want.
Could you structure it so it's 15-year fixed?
Yeah, I could basically do whatever I want. And here's an example of another whatever I want type of deal I've set up many times is if I'm doing a second mortgage, I'll say, you know what, let's make it, let's say it's 8%, but it's going to accrue with no payments, and I'm going to pay you out at the end of the term. So at 5 years, let's say it's a 5-year term. I owe you 8% per year for 5 years, and at the end of 5 years, I'm paying you back your principal plus the accrued interest. because what are you going to do with the money anyways? It's like if it's a small mortgage, it's just going to sit in there, little dinky amounts that's not going to really, you can't do too much with.
Okay,
So
but it's very, very flexible.
It helps me because I'm trying to keep the cash flow at a manageable level. If I have to pay out high interest costs, then I might be struggling, right? So this allows time for the property to go up in value, for me to force depreciation by renovating and so on.
Let's talk about the dark side. Obviously, the borrower decides to leave the country and decides to, what happens? Just maybe explain what happens if, worst case scenario.
It's fairly straightforward. It's like with any other mortgage. Like if, for example, let's say you've got a bank mortgage with TD Canada Trust.
Okay.
And let's say you stop making your payments. Well, if you're in Ontario, what's going to happen? You're going to get a letter from the bank saying, demand letter basically saying you owe this amount. And if you wait long enough, in Ontario, they will sell your house out from under you with a process called power of sale. Okay. You as a mortgage lender, you're lending money to me as one of these arm's length RRSP mortgages. You have the same ability. So if I stop paying you, you basically call up your lawyer and you say, Paul, stop paying me, sell the house under power of sale.
So there's a legal document that he's allowed to sell the house.
It's a legal take-back process that's part of and it's standard in each province.
What if you're in second mortgage? Doesn't the first mortgage force the sale? You can still force the sale if you're in second.
Now, oftentimes the first mortgage holder will, depending if they don't want the sale to go through, or they can catch up on the second mortgage payments. That's not as common. And I don't want to get into too much of the details on that, but just know that there is a legal take-back process, a legal sale process. And in some provinces it's foreclosure, in some provinces it's power of sale.
So at that point, if that happens, worst case scenario, if you put the property for sale, then you get fair market value or whatever you can get for it, then it's possible you might get less if they can only sell the house and it went down in value, let's say, then you'll get part of your RSPs back. Maybe more, maybe the same amount, or maybe less, depending on how much they were able to sell the house for.
The most you would ever get back is the amount of your principal loan plus the interest that was owed to you. This is one of the only investments that I know of that has underlying security, and it's not just some fluffy kind of paper thing or theoretical thing. It's a physical property.
Yeah, exactly.
Okay, so that's where there's a huge difference between that and the stock market. Again, there's pros and cons to everything. But it's a great investment. Why do you think the banks put billions of dollars into mortgages? There's underlying security there. The banks are not typically, unless you're looking at the U.S.
Canada,
banks.
U.S. banks is just another story. That's another 3-hour discussion.
It is. But in Canada, banks lend in mortgages. They deal with other types of loans and stuff as well, but they tend not to be stock market gamblers.
And they're pretty conservative in their lending. They always have a margin of a cushion. The
way I see it and the way I explain it to people is that, if it's good enough for the bank to do, why isn't it good enough for you to do? There's an underlying physical asset that's security there.
Fair enough.
So how often do real estate markets go down by 30% in a city or town? It doesn't mean they can never do it, but the chances are very, very low. And the way you can protect yourself is you have a buffer of margin there by making sure that the property is not overfinanced. For example, you wouldn't want to have
95%
or 100% financed property, except in very specific situations. There's only a few that I recommend to people, and it's basically for more advanced investors that know what they're doing. But here's
for our advanced
for more advanced investors. So if somebody comes to you and they say they want to finance their property 100% using your money, I'd want to see a plan as to what they were going to do very soon after to increase the value of that property, or proof that that property was being purchased under market value. And so, for example, let's say let's say somebody came with a property that they had purchased or they were buying, and they paid $200,000 for it, but it's worth $250,000. There's $50,000 in equity
right there,
buffer. There's protection right away. So if you're financing 100% of $200,000,
in reality, you're not at really 100%.
You're not 100% of the market value of the property. Okay, so that is one example. So if the property is being purchased under market value, that's an example of how you could do that.
Okay.
Another example, let's say somebody was buying a fixer-upper property, and they knew within a very short period of time they were very experienced at doing this. They could renovate the property and put new tenants in and raise the rents and raise the value of the property in the process.
Okay.
That's another example as to when I would say it's okay, as long as the person, the investor, is experienced enough to be able to do that.
Yeah.
But what I've seen sometimes is people, they'll finance up to 100% of the property value. The property is already in great shape, no chance for increase in value. It's not been bought at a discount.
Okay.
And so that I wouldn't recommend.
Okay.
So there has to be some sort of equity buffer there.
So the type of RSPs that people can use to do these transactions, obviously personal RSPs, spousal RSPs, group RSPs, LIRAs, locked-in accounts. Can they use those, or it has to be a personal, just regular RSP and a spousal RSP?
Any type of RSP qualifies. LIRAs also qualify.
Okay.
Basically, almost every type of retirement account doesn't. I think there's a disability type of retirement account doesn't qualify. TFSAs are relatively new. There is only one trustee that I know of that does those, and if I remember right, it's Canadian Western Trust, which I don't.
So people
deal with.
can use their TFSA as well into doing these.
Yes.
And the good thing is that they're not taxed on any of the growth and at withdrawal, which is good.
That's correct. But TD Waterhouse doesn't, as of yet, deal with TFSAs.
All right.
RESPs, so the Education Savings Plans.
Yep.
Olympia Trust, I believe, is the only trustee that handles those. So not every trustee does everything.
So for the same rules apply. It's, for RESPs, the maximum per year is $2,500 contribution per year. So but somebody has already a pool of RESP, 20,000 to 30,000, and they want to transfer it for the next 10 years.
Yep.
Okay.
They could do that. So basically, it's any type of retirement account.
Registered accounts.
Except for the disability one. I looked into it, and as far as I know, they don't qualify.
And as far as exit strategy, when does this deal end? Is basically if the person sells the property, then you get your money back.
That's correct.
It's back in your RSP.
That's correct.
Okay.
And it all stays tax sheltered.
Yeah.
That's the beauty of it.
Yeah.
Because people, at first when they hear about it, they think, well, am I withdrawing my money? And no, it's not. The money is technically coming out of the RSP, but because you're going through this trustee,
you're just switching investments type.
It's a
you're
different
just going
investment.
from either stocks or bonds to real estate. You can buy gold and silver bullion now with your RESPs, RRSPs. It's all staying within the same vehicle.
Correct.
Okay.
It's a pretty cool strategy. One of the best things about it is that you don't have to jump through hoops like with the bank.
Okay.
If I'm dealing with you as an individual, and my experience in buying property, or
there's a level of trust.
There's a level of trust there. And it's not just only trust. It's basically there's a physical asset that's backing it.
It's not just I'll pay you.
Yeah. Well, yeah. Here, lend me $100,000, and I'll pay you when I pay you.
Yeah.
It's not like that. So basically, I don't have to go get. I don't have to get a credit check. I don't have to provide any proof of down payment funds.
Yeah.
I don't have to get job verification. Heck, I don't even need to have a job.
And the money could be used to purchase either the principal residence of that borrower, or also rental units as well, or it has to be the principal residence of that borrower.
Okay, as long as the person who's borrowing the money, as long as they're arm's length from the other person, they can buy any type of property, as long as the property is in the land titles or land registry system. So that means almost everything except for like mobile homes. It's the only thing that won't
what's your address?
Won't get covered. Yeah, basically. You can't drive away with it.
Walmart parking lot.
There you go.
How do people contact you? Your website, it's www.spirepoint.ca.
Yeah, www.spirepoint.ca.
Okay.
And on there, I give basically free education. I've got blog posts on there you can go and read and learn. You can also sign up for my free email tips. Basically on there, there's a little opt-in box on the side. You can type in there, and basically I'll be sending you stuff for free. And there's also listings of my products and services that I offer on there.
So if somebody wants to really become an expert at real estate and learn everything that needs to learn. They can hire as their coach, educator.
And I also have home study programs. I have live trainings as well that I do, depending, like a few times a year in Ottawa. I've been looking at doing it in other cities, but nothing defined as of yet. But basically, home studies, online training, that sort of thing.
So you're obviously you don't sell real estate. You don't. No. You're basically an educator first and foremost. That's your perfect. So here you have it. Hope you enjoyed our first video of this Wealth Acceleration Education Series. We had Mr. Paul Black here from Sparta Point. Thank you very much, Paul.
Oh, thank you.
Appreciate it. And we'll see you next time for our next video. Thanks, Paul.